I'm sorry, I should say this is, one of Ernie's trades in his portfolio. You can also follow the trades in my portfolio. I typically don't like to talk about Ernie's positions, but I'm here to address your questions. So the red hat position, bulletproof trade, a call is sold against it, but we're coming up to earnings. Is there no need for any action? Well, as I mentioned, let's go ahead and take a look here. I'm going to navigate over now to the PowerOptions suite of tools. Okay. There we go. All right, what we're looking at here, of course, is a standard 14-day free trial account to PowerOptions. Those of you who maybe just got started, of course, you want to make sure that you take advantage of the 4 steps that are listed here to get the free quick start guide, the flash tutorial, access to the webinars such as today, and the free coaching session. All right. However, what I want to do is navigate over to our portfolio tools, and I just put the red hat position in following Ernie's trades. So originally, on July 12th, 2017, of course, Ernie opened the red hat position with a stock at 98.80, and originally on July 12th he had opened, of course, a January 2018 100 strike put. Now as the stock moved up, he rolled the put to the higher strike. That's income method number 4. He sold to close his put, I believe, for $520 and paid $740 for the 105. Then later, on August 31st, as the stock continued to move up, he sold the 6th of October, next week's expiration, 107 strike for $410. All right, so that was the action that was taken. But let's take a look at what we really want to see. I'm going to navigate first to the profit and loss chart on the position. Okay, let me clear up those drawings there for us. There we go. All right, so here's where the position currently stands. Including the adjustments, rolling the put, the original put up in strike, income method number 4, and selling the call against it, the total cost into the position is $10,445. So remember I said he originally paid $98.80. This $101.15 for the stock price is reflecting the change in value from the initial put when he bought it, I believe, around $8 and then sold it for $520. So that's reflected here in this 101.15 stock price. There is a call sold against it, which is capping the upside, and at the same time, he does still have the put in place. But because the cost basis at $104.45 per share for the entire transaction is less than what he's guaranteed to get back at the 105 put, it is a bulletproof position with the possibility of being assigned at 107 for a 7.6% max return. That's if the stock's trading right at 107. Now again, I can't speak for Ernie's position personally, what he's going to do in his account. I will definitely mention it to him on Monday to see if he plans on making an adjustment. I'll have him put out a trade brief. But there's 2 schools of thought on this. Number 1, Ernie was originally hoping to get most of that 410 premium out of the position, which if it goes to 0, it expires worthless. He'll keep the 410 and the position will be bulletproof still going into January. If it goes above 107, he'll look to roll it. Your concern is valid, Michael, don't get me wrong. We're in this position. What happens if it gaps up to 116? Okay, we already saw here that if the stock continues to move up, we still won't lose on the position, but we're giving back from the maximum profit. How? Why are we not just getting assigned at 107 and making 7.6%? It's because there's 3 working legs in this sort of collar trade. Okay, it's a radioactive trade with an income method number 1, but it is a collar, just the put is further out in time. So come October 6th, if the stock's trading here at 116, we don't get any more positive delta on the stock because it's negated by that short 107 option. And at the same time, the value is falling away because the put is declining in value. So we're not getting any more positive delta because of the short call on the position. Okay, so Ernie could buy it back right now for $350. That's about the midpoint, a bid of $340 and ask of $360 back up here at $340 to $360. He could close it for $350, which means he's only making 60 cents a profit. Okay, so this would reduce, this cost basis would reduce down he wouldn't be bulletproof heading into earnings. Okay, and that's perfectly fine. He might be able to make another adjustment. That's a possibility as well. All right, so I would consider, and again, I can't tell you what Ernie's going to do with his position. I would consider 3 adjustments, knowing earnings are coming up in the next week if I have a short call open. Now, some of these will apply even if you're just in a covered call and you maybe want to add some protection to it before earnings or not cap the upside. The first and easiest thing I might consider, now I know I haven't made the 410 profit on this position, but if I was worried about a large gap, maybe I go up to the 112 call. Okay, now this is going to cost me 165. What I'm actually going to do is buy the 112 call, but remember I did keep 410 there. So let's go ahead and buy this call here for 165. What does that do? Well, now I've just legged into an income method number 6 position where I still have a decline in the profit if the stock gaps up above 107, but if it starts going above 112 in a large gap, I still have unlimited upside profit potential. Unfortunately, the position is no longer bulletproof. Okay, that's another issue. All right, so if I want it to be, it's only 1%, so if the stock fell 20% per earnings and I did this adjustment, I'd still have infinite upside if the stock continued to move up. Yes, I still have an obligation to deliver at 107, but I own a 112 call that, yes, I paid 165 for, but remember we took in 410 here. So I'm essentially owning that long call for free. And if the stock continues to gap up to 116, 120, has a big move at earnings, I still have unlimited upside profit potential. The stock falls 20%, I might lose 1% on the position. Okay? All right. Okay, so that's one option. Adding the extra out-of-the-money leg, the cheaper price than what you originally received to complete an income method number 6 going into earnings. Another idea, let's take that off the table. Let's buy back our 107 call. Remember I told you it would cost $360. So that's still going to reduce the cost basis by 50 cents. Because we took in the 410, I'm going to pay $360 back. So let's go ahead and put this at $155. Take out our 107 call. Here's where we'd stand if we just bought back the call. We're at a risk of 2.7%. But what else do we see? I've got the 105 put, stock's at 106.30. Okay, so what can I look to do now? Remember what we did before. Ernie moved that 100 put up to the 105. So let's try that again now that the stock's above our put strike price. We go into January. I believe Ernie paid $7.20 for this put, and it's dropped down to about $6. Okay, so we're going to add that back in. We're going to buy to close it at 6, and I'm sorry, I'm going to sell to close it at 6. I'm going to buy to open this one at about 8.55. Okay, so now what have I got? Well, I've got a debit of $255 on the position. I'm adding $255 to the cost basis, but to guarantee a 5-point higher payout. Okay, so let's sell to close our January 105 put at $6. Buy to open the 110 at 8.55. Another $255 debit into the position to gain a 5-point guaranteed exit. So now we're only at a risk of $50 or 0.5% going into earnings. Upside is still unlimited. If it gaps up to 120, have a higher profit than what we do right now if the stock was trading right at 107. And at 115, it's only about 450 or so. Could you bulletproof this? Absolutely. Now that we've bought back that original call, stock's at 106, I lowered the risk to almost bulletproof status with another income method number 4. I want to leave the upside open but generate some premium. The earnings are coming out on the 25th. Let's stay with October 6th, the 14 days out, to get a decent amount of premium. So why don't we go ahead and sell the 110, buy the 115. I'll get $225 and we'll pay 95. Okay, so we're creating a bear call spread, but done in the context, sorry, it's 225? Yeah. Done in the context of owning the stock. I don't have an obligation now to have a capped gain. The upside remains unlimited because of the long call. So now, had a risk of 50 cents, 0.5% going into earnings with another income method number 4. We enter a new income method number 6, adding the bear call spread. No risk on the position, so back to bulletproof status. If it's right at 110, we make 713, right around the same profit we have if the stock's at 107 with the current structure. Now, sure, if it goes to 115, we give a little bit back, but if it gaps up to 120 or 125, a 20-25% increase, we leave the upside open. Okay, so a couple ways to handle it. Number 1, well, of course, do nothing. Leave it as is. If Ernie feels the stock's going to pull back, he feels weakness and is afraid Red Hat's going to come down, just let that call expire. He'll keep more of the 410, have a bulletproof position, then he can reevaluate it after earnings. He could also leave it alone if the stock gaps up, decide to just close the position for maybe a 5 or 6% gain, or roll the call if he feels there's a lot of upside left. That's going to be really hard to do if the gap is significant, of course. If you think there's going to be a large gap, you want to keep in bulletproof status. I showed you another example. Closing out the short call, rolling up the put again with 4, adding another income method, number 6, still in bulletproof status, infinite upside profit potential, and about the same profit now if the stock's at 110 that you'd have if the stock was at 107. But remember, where you are now, it would continue to lose value if it really jumped up to 120 or 125. So, keep it as is, do nothing. We could have added just the long call and completed an income method number 6 with the position as it is. Close the short call, roll the put up, and you could have left it at that without doing this income method number 6 too. Remember, you had about a 0.5% risk going into earnings. There may also be an opportunity for income method number 12 in your blueprint, where maybe you buy to close the short call, and instead of rolling up your 105 put, adding the extra 110, so now you sort of create a strangle. But looking at the numbers, I think that would add too much risk to your position if the stock was maybe trading between 110 and 103. You know, you might have a 4 or 5% risk, but if it's above those parts, you would realize a profit. And that's another opportunity, is income method number 12. So those are some of the ideas, Michael. I can't tell you honestly what Ernie would do, but I'm going to show him this webinar. I'm going to show him the first 10-15 minutes here of our discussion today, a little bit more than 15 minutes. I'm going to show him my ideas of how I might approach it going into earnings and see what he says. Now, what I just showed you was done in the context of a radioactive trade based on the rules in the blueprint that describe the standard structure in all 12 income methods. But this also applies, for example, let's say we were just in a covered call. You've been trading Red Hat for a while, maybe rolled some calls. Let's say your cost basis from 98.80 in July is now around 155. You generated some premium to lower the cost, but you had to roll up a couple times as the stock continued to move up. So you're around 155 with the stock at 106. And let's say you're in the same position as a covered call. That you had sold the 107 call initially back in August for 410. So though we were just talking about a married put, here we are in this position now. We're hoping for a 10.9% return if the stock gaps up. But we've got to worry what happens if the stock goes down. What if this falls 20% and is trading at $80 from really poor earnings? It's extreme, but it's the best way to show these things, okay? Well, I don't want to take what's right now probably about a 7 or 8% gain and could be an 11% gain if the stock's above 107 and maybe give back to a loss of 13 or 14% if there's a gap down. So if you're in a covered call now with a stock going into earnings, again, there's two things you could do. Number one, leave the upside open. I'm going to the 112 on purpose because it's 5 points away. It's just easier to look at a 5-point spread. So I'm going to add that back in. Buy an out of the money call. This costs us 165. So now again, you've got a position here where if it's here, you're still at a profit of 890, but then you still have infinite upside if it continues to move up. You take away some of it, so now you're only at a profit of maybe 8 or 9% if the stock's at 107, 108, 110. But if it starts moving up above 112, there's a large gap upwards. You have more profit. But now we haven't addressed the downside. So what you may want to consider is adding a cheap put around earnings. Okay? And we might want to consider just simply buying, we'll stick with October 6th to keep everything the same strike. They're going to be expensive. We wanted to protect against, say, maybe don't want to give up more than 10%. Maybe we don't want anything. I'm going to put it right here at 101. Why? Because it's, remember, we collected 410. I just paid 165 on the position to add that extra call to leave the infinite upside open on the covered call. And I'm adding a cheap put. We're going to call this 175, round midpoint. Okay? So that means that my total cost in is going to be $3 and about 40 cents. So still 70 cents profit between the put that I'm buying to ensure the position and the extra call I bought to leave the upside open. Does this give us what we want? There you go. Even though you've got a covered call, you can add a short-term put to the position, add an extra long call to the position. The profit here between 107 and 112 is only 7% now, roughly, of what you have invested, instead of the 10.9% on the covered call. But if it does gap to 120 or 130, you still leave the upside open, because that extra long call is going to continue to gain. Yes, you might get assigned on the stock at 107, but you got the right to buy the stock at 112. So it goes up to 120, that long call is going to be worth $8. And then you added an extra put, so even if the stock collapses 20%, which a stop order you know won't help you with overnight, between Monday to Tuesday, but in this scenario, if the stock falls, you've got the put in place around earnings. It could drop to $80 per share. You're still guaranteed a profit of around 1.2% on the position. Pretty effective, okay? And the reason why I chose those two was the combination, of course, between the extra long call at 165 and the extra put, the new put at 101, was a cost basis of only about $3.40. So I'm still making 70 cents positive premium. The call I originally sold is still paying for those two. Okay? So that's an idea. If you just have a covered call and you've got a stock going into earnings, add an extra out-of-the-money long call to leave the upside open in case it really takes off, or just go ahead and adjust the position. Okay? Now, a comment came in from Bing. Bing had said, you're moving too fast, can you slow down a bit? Well, yeah, we wanted to talk about the adjustments that were being made against the buried put. They might not be my adjustments. I'm not sure what Ernie's going to do. And without the backgrounds, Bing, if you own the blueprint, you sort of have the background to what I'm talking about there with income method number 4, rolling up the put, and why you would do it and how to structure it. That's in the blueprint. And then, of course, the income method number 6, right? Adding an extra call. Let me clear out the put we bought. Adding an extra call. If you're already in a covered call, you have a call sold. Might be expensive now, more expensive than if you had done it a month ago when the stock was only trading at 102 or 103. But it gives you the advantage of leaving the upside open. Okay, again, why? Well, let's say the stock went up to 120. I sold a call here at 107 originally, and I'm going to buy the one here at 112. So if the stock really takes off and goes up to 120, what's my outcome? Okay. Well, here's what happens. I do get assigned at 107, but that's okay. My cost basis on the stock is well below it. I keep the 410 premium. Most of it, because I use some of it to buy this extra call. So I'm out of the stock. But now if it runs up to 120, what happens to this 112 call? that I paid $165 for. It's now worth $8 of intrinsic value, maybe a little bit more, $805, $810, because there's still 14 days to go to expiration on the position. So this is one way where if you're in a covered call, you're coming up to earnings, you don't want to spend the money to buy the call back right now, but you want to leave the upside open in case it really runs up. You can add an extra call. Now I threw in another term there, Bing. I said a bear call spread, what we call income method number 6 in radioactive trading. That's in the construct of doing the married put and the 12 different income methods, all right? That's the 6th one. But the bear call spread, what is it? Well, this by itself, selling a 107 call at 410, buying a 112 call at 165 is a bear call spread. We take in a net credit up front, but we're risking the difference in strike prices minus the net credit. Okay? So it's a vertical spread. This one's really, really high because we legged into it. So we've got a really high premium here. But if the stock starts to move up above 107, we start losing money. In fact, the break-even's at 109.45. And that's because in this spread, I've sold a call which obligates me to deliver shares of stock I don't own. And if it goes above 112, well, I own the right to buy shares of stock. So if it's at 120, I can buy stock at 112, but I have to sell it at 107. So I take the 5-point loss, but I keep that 245 net credit. Now, that obligation is negated when you own the stock, because now what it really is, I think it was 100.55 was my cost basis. What this structure really is simply a covered call with owning stock at 100, having a covered call at 107, and buying an extra call at 112, which you were essentially paid for, because you collected 410 and you only paid 165 back out. Okay? It leaves the upside open. See, the max profit here is infinite. Okay? And it's infinite, of course, because if the stock went up to 140, even though you get assigned at 107, at 112 keeps going up. And then I added the extra put. And that's because I don't want this to turn, if I'm in this position, stock is at 106. Earnings are really bad and it gaps down 20%. And we saw that with, wasn't quite 20, but Bed Bath & Beyond this week dropped down about 15%. Now, I was in a long straddle on that position, so I made a really, really good profit on it. CarMax today was another good long straddle. It was in the other direction. I think it went up about 10, 12%. So there's really good profit on that one too. But when I'm long stock, I don't want to take the chance. So in that case, I added a put option. And I stuck with October 6th, not even saying that that's the best series to do, but to keep the expirations the same to make the graph look cleaner is why I really did it. Okay? But although I wanted to really buy maybe a 106, the problem is now that the cost is so much that if I paid $350 for this 106 put and $165 for a 112 call, I've got about $5 now. My 410 premium is negated. So I wanted the two costs of the extra long call to leave the upside open and the put to protect against an unexpected downturn with earnings coming up. Add that back in. Put in 175. So now the cost between the two, the 175 for my 101 put and the 165 for that extra 112 call, it's only 340. I'm still 70 cents positive premium for what I already collected. And you've got a bulletproof collar with a kick. Best way to phrase it. Okay, so it's a collar where I'm long stock, sold the 107 call, and bought the 101 put. But it's still bulletproof. The stock could gap down at open Tuesday after the earnings announcement or after hours. It could go down to $80 per share. I'm still guaranteed to make a 1.2% profit. Not near the 7% I have right now or the 7.1% return if it was trading up here in the 110 to 107 to 112 range, really. But I'm long stock or in a covered call that dropped 20% and I made 1.2%. I'd be pretty happy with that. Again, taking a step back and looking under the giant umbrella, of the big picture, if you're in a covered call and you've got a profit of 8 or 9% right now and you're worried what could happen, maybe just liquidate the position, take the 8.9% profit that you've got, and then look to enter the trade after earnings if they're positive and you've got the capital. Or if it falls and you think it's a good buy opportunity, maybe get back in. But if you don't want to risk anything, just get out of the position if you're comfortable and the profit has hit your goals. But if you want to protect it, let's talk about buying a put. On that note, I've got a couple questions coming in from Rajiv, and I'm going to get to you in just one second. Rajiv, I promise. But if you have a stock right now, and this is part of the, I don't know if you guys received the email, but we started part 1 of the series on stock or portfolio insurance. It was posted in the blog this afternoon, and I'll try to post part 2 this weekend. It'll be a YouTube video, and it'll be available in the blog. And then we'll have 2 or 3 other parts coming out shortly after that. But let's say I'm in Red Hat, and I bought it when Ernie did at 98.80, and I didn't do it as a married put. I didn't do it as a covered call. I just have a gain in the stock, and I know earnings are coming up on Monday afternoon, after market. So what can I do to protect the gain? Well, this is what you want to do. If you've got a stock that you're sitting on that's in a gain, whether you've got a covered call on it or not, okay, or if it's just open stock, go to the Married Put tab and click on Insurance. It's a real simple tool. We just put in our stock symbol, Red Hat. My cost basis per share is 98.80. Okay, and what I'm going to do is I know earnings are coming out on Monday. So right now I'm just going to look to buy a put for October, shorter term, to lock in some of the gains. Now this tool shows me, okay, I've got a 7.6% unrealized gain on the position. Now I could buy a variety of different October series. The 13th of October 111 put would cost me $660. So my new cost basis is $105.40, but it's the 111 put. So I could lock in guaranteed profit of 5.3% even if the earnings disappoint. Okay, so let's take a look here. Let's just go to the profit and loss chart from this tool. All right, so I have a 7.6 unrealized gain. Buying the 13th of October, it's in the money, the 111 put locks me into a guaranteed profit of 5.3%. And then, of course, with a stock at 106.30, I could say, well, again, what if I sold the 110 and bought the 115, did that income method number 6 again to leave the upside open? You could put that in manually to see how that would work. Back on the insurance tool, it will allow you to create a collar, but we want to go a step beyond that. We want to look at that income method number 6. It leaves the upside open. Okay, so just for the sake of argument, I could go out to the 13th, get a little bit better premium, 110 at 220, 115 at 110. I'm sorry, 240 and 110. So again, I'm opening a bear spread, but in the context of owning the stock. I'm sorry, was it 110? My apologies. Yep, 110. Midpoint. All right. So here, it's a weird, we've got a big dipper profit and loss chart that keeps going up after it breaches 115. Okay, so this would continue to go up to that infinite profit potential. But we do get a big dipper handle here where we're making a profit of only, looks like about maybe 580 or 570. Yeah, 595, I'm sorry. 5.7% if the stock again is trading between 110 and 115. And then we're bulletproof here down to about the tune of 720 or so. A little interesting. A little big dipper profit and loss chart there for you. But that's another way you could do it if you just own the stock. Use the insurance tool to see which put option might lock in the best profit for you based on your time frame and where you want to cover it to. We could go further out in time on that tool. We just took October because we know the position's coming up to earnings in the next few days. Okay, we lock in 5.3. We can enhance that with an income method number 6, but as we saw, you get that little big dipper profit and loss chart. All right, so that's the tool to use. If you've got an unrealized gain in the stock, you want to lock in some of that profit before earnings or either just to continue the trade with no risk. Check out the insurance tool under married put or long collar. Put in your stock symbol, your cost basis, see what insurance you can lock in on your individual stock position. All right, now Rajiv, you were talking about AMD. And give me just 1 second here, ladies and gentlemen, on this one. I just want to do something real quick. There we go. Now, we bought AMD, 100 shares, cost basis of $13.48. This is another married put. And you bought an April 18 put at $2.87. I'm going to assume it's the 15 strike. You said April 18, but I think you meant 2018. Okay, and now we sold the October 6th 13 call for 56 cents. Excuse me. Bought and did an income method number 6. Bought the 13.5 call for 68. Ooh, that's not right. Okay. And he said, is this the perfect setup for a bullet position with limited risk? How to manage this if the price moves up? Okay. The one thing I don't like about this, Rajiv, is you legged into it. Oh, you bought 2. Okay, I see what you did. I'm sorry. You bought 2 of those 13.5s at 68. Still not what I would do. I do what's called income method number 5 a little bit differently. But that's okay. This is sort of like a married put, but not. And I'm going to make the assumption here. Oh, I'm sorry. I want to go to custom spread. I'm going to make the assumption that the put you bought in April, you said 287, so that might be the 13 strike. I just can't see what strike it is if you bought the 13 strike put or if you've got the 15 strike put. But anyway, let me build the position. 100 shares of AMD, 13.48. April. Now the 15 right now is about 287, so maybe you've got the 14 put. Okay, hold on 1 second, folks. Okay. All right, let's just take the 13 put at your price of 287. Oh, it was the 15. I'm sorry. Good. Okay, the 15 put. Now this is another thing I don't like about this position. I'll explain why in a moment. So originally, Rajiv has a far-out married put position with a risk of 8.3%. All right, now, to hedge some of that cost, he sold an October 6th 13 call for 58 cents. 56 cents. Okay, sorry, folks. Now, just look at this individually. Why don't I like this position? Because you sold a call below the put strike price. All right, so by itself, you've now given yourself 2 ways to lose and only a max 1.6% of profit. Okay, you receive a small premium of 56 cents, but remember, you had close to $1,620 invested in the position with the stock at $13.48 and the put at $287. All right, so it's really more like 35. I'm sorry, it's more like 1635 was originally invested into the position. So when you sold the 13 call, you did lower the cost basis by 56 cents, but now the risk goes up to 17.7% in the upside in the direction you thought the stock was going to go. That's why we don't like to sell calls below the put strike price, because it actually creates a bearish position and gives you 2 ways to lose and increases the risk to the upside in the original direction we thought the stock was going to move. All right, but you hedge that. You try to protect against that. And what you did later on, same series, October 6th, you bought 2 13.50 calls. Now, I got to ask you another question, Rajiv. You told me that you bought 2 13.50 calls at a price of 68. Does that mean you paid 34 for each? Or was it 68 for each? I think you meant it was 34 cents for each. Okay, so the total was 68 cents out, $68. All right. Now the question is this a good bullish position to be in? It's interesting. It is bullish. You've countered the obligation of the 13 call. Now I can break this down into many different ways, but you probably don't want to hear it. What I mean by that is I could look at this as a married put, stock plus put combination. Here's our married put position with a bear call credit spread and an extra long call. All right, because you bought two, so you've got a long call 13.50, you paid 34. You've got a 13.50 bear call credit spread mixed in here at a net credit of 22 cents. Okay, with a risk of 28 as the stock moves up. So, is this a good bullish combination? Well, yeah, it is. Problem that I have with it is that to do it, you increased your risk. Right? You increased the risk because this would have to be done at a debit. You added an additional 12 cents. I know that doesn't sound like much, but the overall risk increased by more because you added 12 cents to the debit, and if the stock does keep moving up above 13.50, above 14, you also lose an additional 28 cents on that bear call. Now that's going to be countered by the extra long call you purchased. But your question is this a good bullish position? Well, the graph says it is, right? What is a bullish position? One that gives me infinite upside if the stock continues to move up without having a capped gain or giving back too much, while at the same time having some controlled risk in place. The problem is you increased your risk to do this. Am I saying there was a better adjustment you could have done on this? Not really. I'm not saying that right now. I'm saying you might have reacted too soon. Okay? Yeah, in this case, both the stock and the call will move up. That's right. And the put's going to decline. And in order to do that, you paid a debit, which increased the maximum risk. Now, let me do something real quick. I'm going to open it again. I'm going to leave both open. I'm going to eventually toggle between the two, but I'm going to try to do it seamlessly so it doesn't flash on your screen. I'm going to put in the position again, 1348. And April. I know you're not seeing what I'm doing. I'm doing that so that it's easier to see here. And your put was 287, 287. All right. Okay, so what we're looking at now, make sure it catches up there. There it goes, caught up. Here's your original married put with a risk of 8.3. Am I splitting hairs over 0.6% increased risk? Maybe, but I don't really like to increase the risk unless the stock's not moving in my desired direction. Why am I showing you this? Okay, well, if the stock's at 15, you have a loss of 1/3. No, I'm sorry, my apologies. I can't do it that way. Let's scroll down. Let's use our calculate expected profit and loss. This is the married put by itself, without your adjustment, Rajiv. If the stock was trading at 15 on October 6th, okay, with the volatility of the put is showing it'd lose about 80 cents, you'd gain about $1.52. It's close to that, so you'd have a profit of 68 cents on the position. Okay. If the stock was trading at 14 on October 6th, you'd have a profit of 15 cents. It's about 1%. Okay. And of course, if the stock moved up to 20, I know it's extreme, but I'm just putting it in there, you'd have a profit of 432. And if the stock fell to 12 on October 6th, you'd have a loss of 68 cents. Okay? I'm writing this down on the side. Now, let's go back to your position. Here we go here. Now, same thing, your expiration on October 6th. If the stock moves up to 14, you have a gain of $3. You would have had a gain of just 15 cents had you left the married put alone and the stock was trading at 14. Okay? We know that if the stock's at 14, the 15 strike put for April is going to have the same value that we saw in the other one. Your 13 call is going to be worth $1, and your two 13-15 calls are going to be worth $1. Well, these negate each other, right? Because you sold this one and you bought two of these, so this is a negative against you. You'd have to pay $100 to close this position, and you could sell to close these two for $100, so it's negated, and you only make $3, where we would have made 15 just leaving the married put alone. Okay? Now, what happens if the stock goes to 15? Okay, so now it's starting to kick in, isn't it? If the stock moves up to 15 by October 6th, you'd have a profit of $156 as opposed to 68 cents that you would have had just by the married put in itself. Okay? Because now that 2-for-1 deal is starting to pay for itself. Probably really at about $14.20. I'm just going to take a look here. At $14.20, can we beat 15 cents a profit? Yeah, we're about 33 cents and gaining higher. So right about $14.50 is when it starts to take over, when this extra long call is more than paying for what you'd have to buy back your short one at. Okay? And of course, what was our other example now? If the stock went up to 20, you're at $1,020 as opposed to $432. You'd have profit with just the married put by itself. And if the stock fell to 12 on October 6th expiration, you'd have a loss of $80 as opposed to only 68 cents. All right, so what I'm saying is the married put by itself, the stock fell to $12 on October 6th, we'd have a loss of 68 cents. With your structure, you're going to have a loss of 80 cents. The stock rifles up to 20. Your married put by itself would be a profit of $432. Your adjustment would have it at $1,000. If the stock's at 15, you make double what you would have on the married put. But if the stock's only trading at 14, I make 15 cents on the married put, a little bit above 1%, you'd be at a gain of only 3 cents with this structure because you added to the risk because of the debit. Okay? So where am I going with this? Is this a good bullish structure? Yes, if you're extraordinarily bullish on AMD and you think it's going to be going above 1450. We just saw that was about the sweet spot where everything takes over. If you think it's going to go above, 1450 right here in the next 2 weeks to October 6th, your adjustment pays for itself. If it stays within this range between $13 and $14.50 or drops lower, anywhere below $14.50, married put would perform better. Okay? Because remember, you had to add to the risk to do it. 0.6%. Splitting hairs, well, that's the comparison, right? We saw that at 14, if the stock's at $14, your adjustment here only makes $3 total, 3 cents. Married put would make 15 cents. That doesn't sound like a lot, but based on the cost basis, it's about a 1% gain. Okay? So, it's a good bullish structure. You got to be really bullish on AMD by October 6th for this to make sense. I'm sure you are, which is why you did it. But the benefit doing this at a debit, even though it's only a debit of 12 cents, remember you could also lose the 22 cents inside this bull call spread, so you increase your risk up to 8.9%. That's the scenario. What have we got with AMD? Let me go to the stock research tool here. See, that's the thing. Now, it's unconfirmed, so they haven't officially announced it yet. I would say your position that you did makes sense if earnings were coming up between now and October 6th and you were expecting a big push up to $14.50, $15, $16 per share. From what I remember from AMD, just looking at the charts, I know it had a big hit recently. I'm sorry, I'm on a 1 month chart here. I know it's been moving up. That's what I was thinking of, the big hit the other day when it dropped from 14.25 back down to 13.50 here. It has been moving up strong, and it could, if it recovers and gets back to where it was 3 days ago, 14.25, 14.30, 14.50, that could pay off, but you need it to be up there. If it just stays in this range around 13.50 to 14 or 13 to 14, you're not going to have as much gain as you would have just with the married put, okay? All right. I'm okay. All right. So that's my thoughts on that. I'm sorry, Roger. I saw your question. I just had to cover this topic first. I know you asked it about 5 minutes ago there. Okay. All right. So Roger wants to talk about the weekly picks of the day. It's a service that we offer for our subscribers under covered call, naked put, and essentially even credit spreads. And Roger's looking at the covered call weekly picks of the day. And right now he says, well, I see CBI, Red Hat, which has earnings coming up, and CF Holdings, which has a good premium as well. I'm sorry, that's Restoration Holdings. That's not RH. That's not Red Hat. I'm sorry, RH, Restoration Hardware. They had their earnings, I think, a week or two ago. All right, so let me go back to the search. I'm not seeing which one he is. It might have been a historical one. I don't track these. Excuse me, let me say something here. Is AXON on here? No, Roger, this might have been from a few days ago when it came up. I'm not seeing it here today on the weekly covered call positions. Oh, it was monthly. Jeez, Roger, I'm so sorry. Monthly picks of the day. AXON. All right. Buying a stock at $25.30, getting $12 for the $22.50. Okay, so you want to talk about what are the pros and cons of this position. It's highly inflated. It matches the criteria that Ernie tested, of course, over that 1-year period. If you click on see how we develop these results, again, that walks through what he did. Has earned 10 to 20% per year, writing the covered call positions. Backtesting period was for 1 year, and I tested both in 2 years and through 2017, and they were both still positive. 30 positions, okay. He talks about the criteria and how he set it up, but on average, that testing period was a 24% return. It was actually above 41% over the 2-year period with the losses and the gains in there, and both losses were the result of a 30% stock price drop. Value of the drawdown was 21%. Okay, so what are the pros and cons of this position? Let me go back to covered call and into the search. Sorry. Instead of the weekly picks of the day, I want the monthly picks of the day. All right, so what is our downside? You've got about a 50% downside protection. What's the risk? Well, in this case, I don't know. Let me go to the news real quick. I'm sorry. In this scenario, it's up 81 cents, up to 25.80. I'd want to research this position. All right, and it says traders expect an 80% move in the next month. Okay, why? They've probably got a drug hanging in there somewhere. Expect huge moves in Axon Sciences. I'd want to read these. So they've got a drug in there somewhere. It just rose 7.2% a few days ago. It's going to be a short share rise, okay? And it went to a 93 RS rating, okay? Well, this is one of those biotechs, okay? You'd want to research this further and analyze the position. Of course, the premium's huge. That's why it came up in Ernie's search. My apologies. There we go. And it's a potential 68.9% return, and we saw it had a 56% downside protection. What's the fault? Well, the fault here is the same thing that could be for OTOC or OTCI. I can't remember what the stock was. If that drug does have a phase 2 or, if this company does have a drug that's going through phase 2 or phase 3 analysis, this stock could potentially drop 80% of its value. You could see it trading at $1 per share. Simple as that. It really could. We can't control that. It came up, it matched the criteria, it's been growing. We saw that it just had moved up 7% based on the news, and we could see that on the stock chart as well. It's a 68.9% return. If it looks too good to be true, it probably is. This stock could also gap up to 40. I don't know. Okay? There's a lot of pressure there. If you think it's too good to be true, even though it came up in the search, 50% downside protection to a 68.9% return if assigned for a 1-month trade. What do you know about this stock? It could drop to $1 per share anytime between now and October expiration. That's fact. It really could. Is it a 50-50 shot? I don't know the statistics. It might be 55-45. It could gap up to 35 or even 40. It all hangs on what it sounds like is in the pipeline. Okay? If it falls to $1 per share, what's your loss? $1,184. If it stays above, I apologize, 20? Yeah, I'm sorry. If it stays above 20, what's your profit? $816 or 68.9%. How about this? You're interested in this stock and you love the premiums. 68.9% is unheard of. Why? Because there's so much implied volatility, because the stock could drop to $1 per share. It could go up to $40 per share. You've got protection in place here at 50%. What if we want a little bit better? If this looks too good to be true, which it probably is, it could happen. It could also go to $1 per share. I'm just being dead honest with you, Roger. So what would I take out? I'll take another structure. Let me go to October. Stock, I'm sorry, was at $24.99. Let me try this. 25 call at 11.35. 17.5 put at 6.55. All right, so I'm taking away of half the potential profit here to enter a collar on this position. Why? I wasn't hoping for that. Put strike's too low. I'm still risking 13.3%, which I wouldn't take. But it is a 2-to-1 reward to risk ratio. Look at that. I could still make 23.8%. About a third, but if the stock fell to $1 per share, I can only lose 13.3%. 23.8% is a fantastic return for a monthly covered call. It's not the 68.9% you're looking at right now, even with that in the money. But if stock falls to $1 per share, you can't lose more than 13% on the standard collar. You could get a better risk-reward ratio by going to the 20 strike put, but now your return is probably going to be much lower. All right, so let's go ahead to October now. 20 strike put at 8.20. Hey, all right, not bad. 8.4% maximum risk. Even if the stock fell after hours to $1 per share, still the potential for a 14.5% return. Okay, so I might take this as a collar. If I was to open AXON, I would personally open it as a standard collar. Why only look to make 14 or 23% where I could make 68% with the covered call? Because even if I use a stop order, that drop to $1 per share is going to happen after hours or when trading's halted. And when trading reopens, it starts at $1. Even if I put in a 5% stop loss on this position, it's still a 97% loss. Okay? You know, you're collecting $12, you've got a 50% downside protection. You could still have a 40% loss or 100% loss of what you have invested to it if the stock drops to $1 per share. Doing a collar, a 1-month out collar where I'm guaranteed to not lose more than 8.4% and I can still make 14.5% if I'm assigned at 25, think about it. That's not 68%, but this is still probably 5 times the standard covered call profit you'd expect on a monthly position. On a monthly covered call, the average for a good stock is looking at 2.5 to 3% return if assigned based on the average volatility in the market right now, about 0.33. This is still 5 times that with a guarantee, no way to lose more than 8.4%. 14% is still good. Roger says it's right. It's fantastic. Okay. Bing, no. I don't mean that to sound negative the way I said. Okay, Bing says buy. Yeah, okay, Bing says, how about sell the October 20 put? No, that's not what we want. That puts us in the same structure as a covered call. But this is what we're doing here. This is the October 20. I started off with that 17.5%, 17.5 strike put, but the risk was 13%. not bad if the stock fell to $1 per share, okay? Bing wants to look at the opposite structure. That's fine. Okay, so Bing says, what about doing the October 20 put, but then getting more for the December call? Do the December 25, 1220 to 13, so we'll call it a 1260. Okay? So we're going further out. We're selling the December call for more premium, buying the October. Now this might look weird and what you're not expecting, Bing, but here's the problem. This is the profit and loss chart at October expiration because we've done a reverse calendar collar. Reverse calendar collar, meaning your long put is shorter term and the call premium is farther out. There's no profit here from 5 to 40. Why? Because that December call is just as inflated as the October options. Meaning what? Meaning that even on October 20th, if the stock falls to $12 per share, unless volatility comes back, wow. Sorry about that. Unless the volatility on that December call collapses, it's still going to have a lot of value. You protected it here, but not enough to cover the loss in the stock. Okay? Yes, you got a higher premium, but you're still going to have to pay $2.70 to buy it back. Okay? And what you're talking about, what you're talking about is call is equal to put premium. That's not it. Okay, that doesn't really help the situation. The reason why, Bing, is this profit and loss chart at October expiration, if the volatility remains the same, if it gaps up or if it gaps down, if the volatility hangs in that area, which it might not, but if it hangs in that area, it's going to cost you too much to buy back or even close the further call to help counter the situation. Where's the 21.2% return? It occurs only if the stock's really, really high up here, around $60 or $70 at October expiration. Okay, that's the key. All right. Now, even if you find them at the same premium, you don't. I'm just not a fan of selling the call that's further out than the put. I don't like the cover. I don't like the structure of that trade. I don't think it's a bad idea personally. Okay. Yeah, the risk is limited, but at the same time, it doesn't give you the benefit of really what you want. Now, what you probably want to see is let's do the 2250 at 13 and the October 2250 at 960. Okay, so December call about 13, now 1310. And I'm going to buy the October 2250 put, I said, for $9.70. So now you're getting $4 of positive profit, tighter swing in between, same strikes. But see, it's still, it's no good. It's no good on this position, okay? Really isn't. I'm not, yeah, let's see, we call this a reverse calendar collar. You know, where the premium, even when the premium is equal to that as well, you're talking about if I just did the 20, sorry Bing, let me do that example for December on, it's still not going to look right. Anytime you sell the call that's further out than the put, I know there's a gentleman that teaches this, he's a very smart gentleman, he knows his options well. I am just not a personal fan of it, because the structure of the trade really gets to you, especially in this scenario. If the implied volatility doesn't work in your favor, if the event happens in October, sure, the put protected you, but you can't get any advantage of this. Right? The time value doesn't really decay unless the implied volatility collapses and there's a huge movement in the position, which means you're going to lose more on the stock than you're going to gain on the call. It is protected, don't get me wrong, I'm sorry. It is a very protected position. It's got low risk. But with the high implied volatility here, it's also got a very low return, and it's to the downside. And the upside, there's no profit, okay, at October expiration. Why? Because the cost combined, now I have a cost basis of $19.29, and I've got a December 20 call, which doesn't decay until I get closer to December expiration, right? So even if the stock stays at 25, my put expires worthless, I lose the 820, I've got $4 here, but I sold a 20 call, and so I'm right at about effective cost basis of being assigned at 20 or no profit. The profit here really goes down to this side. You need the stock to be below 5, and if I was looking at this position, I really thought the stock had a great opportunity of dipping below $5, I'd pay the money to just trade a long straddle. Or maybe buy a put option against it, you know. Very expensive, but I'd look that too here. A ratio spread could work in these numbers. You could try to develop it as well, but I prefer to sell the call shorter term and either keep it as a standard collar or have the put out further in time if I'm hoping to hold the trade long term. I'm not a fan of that sort of reverse collar idea. It doesn't appeal to me. It doesn't appeal to my strategy, my trading goals, I should say, personal preference. In this case, the risk is too much. These high applied volatilities, the risk is too much to take for too small of a return. Okay, and you see it that there's no real range of break even after the stock dropped below 582. Now, this might be a bad example. I might have picked the wrong strikes for that to be a successful trade there. And Rajiv said there's a chance the stock goes to 1, but upside can still be big. You're absolutely, it could go to 40, to 50, to 60. It could go to 1. You know, so that's the risk here. Bing, I wanted to show you something real quick. If you later on, if you go to our free webinars page, and I'll send you the chat link. I don't know if you've seen this one. Oops. Okay, it's poweropt.com/webinars.asp. This is our public webinars page. Under the requested topics, where I'll publish today's webinar once it's converted, we talk here about collaring a long call stock or portfolio assurance, collars on high implied volatility. Let's see, I want to go back in time. I know there was one here we discussed recently. It's not this one. Covered costs, playing IV run up for earnings. There it is. I'm sorry. April 7th, 2017. Reverse collars. So the first 10 or 15 minutes we go through a discussion on that checkmark profit and loss that you're talking about on a reverse collar versus standard collars and married puts. And I've got another webinar that's not archived here. I don't believe it's not archived on PowerOptions. I have it on YouTube. I'll send that link to you, Bing. It was called Trade Comparison, 3 Core Principles in Trade Comparison, where I break down the 3 core principles of radioactive trading. And I also showed the comparison of a standard married put against that reverse collar we're talking about here. And why do I call it a reverse? Well, it's because the short call is further out in time than the long. And we ran through some different examples so you can see that. Now, on a normal stock position, Bing, that graph looks better, okay? Oh, Martin, yeah, I'll send you those links as well, comparing the collar, the reverse collar to the there. This isn't a link. You can go to it any time, Martin. I think you're even the one that maybe, I can't remember. I shouldn't say that, Martin. I can't remember who brought up the question on the reverse collars. I can't remember if it was a gentleman named Brad who brought up that underscore. Here's another one, too, reverse collars for earnings. So you can watch both of those from March 14th to April 7th. The gentleman who was promoting the reverse collar concept as a limited risk trade was really doing a lot of advertising during this time frame. And I have no problem with that because we are getting a lot of questions about that coming from that gentleman's discussion, what he was teaching and the products he was offering. And I'll be more than happy to compare that and take a look at it, and we did. Okay, so we talked about the reverse collars for earnings because on a normal stock, Bing, that doesn't have this volatility, it does sort of look like a straddle or strangle. Let's just take Apple. Let's go to the custom spread view. And I'm just going to take Apple. I'll just go at 1 month, the standard October expiration. I'll buy stock today at the current price. And I'm going to go to a standard October expiration, 28 days out. And I think I'm going to sell the 152 call. Oh, I'm sorry, I'm doing it wrong. I'm going to buy the 145 put. Why not? 107 for October. And I'm going to sell the December 155 about 520. Okay. That was the errant one. I'm sorry. 1 point. What did I say? 15? 105? Oh, yeah. About 110. All right. Let's take a look. See now, with normal implied volatilities, normal, not that exasperated one we were looking at. Here we see the kind of profit and loss chart that a reverse collar, what I call a reverse collar, is looking for. At October expiration, if the stock moves up, I might still be able to make 4.7%. I'm only risking 3%, and that's the worst case scenario if the stock falls right to that 145 mark and staying there at October expiration. And now you think, well, oh, okay, so the stock moves up here to 152 or 155, I can get assigned and I keep the net credit. No, you don't. No. If the stock's at 155, okay, now you have a profit of 174, about 1%. But if the stock's trading at 155, 120, what happens? I'm sorry, 155 at 1020, what happens? Your call goes up. All right, you don't get this 520. You can close it for 547. You lose $27 on the call. You lose the full 110 on the put, and you did gain 311 on the stock. So if the position's at 155, I want to show you this. If the position's at 155, you make 174. Okay, in 30 days for 4% movement as well. Now, if the stock drops to 135, you only lose 310. And if the stock's trading at 145, we know we have a loss of 448. Okay? But at October expiration, if I want to stay in the position, I don't make anywhere near the 700. I only make 174. About 1%. And then you say, oh, well, you just buy another put at 150. Okay. So I buy a 150 put for November. Now that the stock's up higher, it's at 155. So we go to November now. Oh, I got to remember, I got to account for that 110 loss we just took. Someone remind me of that. But I buy the 150 put, and it's at 490. But I'm going to call it $3. Why? Well, because if the stock's at 155, my put's 5 points out of the money, and that's about where the 145 is. So I'm going to buy this for $3 at October. I'll even say $2, okay? But remember, I paid 110 for a call. I'm sorry, I paid 110 for a put that expired worthless. So now my cost base in the stocks is 152.99. Okay, so now you've only got a 1% maximum risk, but you've lowered the profit to 3.4%. And again, that's only if the stock's up here. If the stock, again, at November expiration now, is trading at 155, I'm only making 137. I'm not making that 512 yet. Okay, I'm not getting that full 520. It's not decaying in my value. Yes, I have if it really collapses, I have no risk to the downside. Okay? And there's only a 1% risk here. I get it. I do agree with that. But this 512 is if and only if a large gap happens. And your call goes right to intrinsic value. It's not. You're still having to buy it back. You haven't realized that 520, and you're adding another put to increase the cost basis. So here you are 60 days into the trade, and the max profit's only 3.4%. I don't like that. Okay? Well, it's better than some of my married puts do. I'll admit that freely. Okay? I'm not saying that. What I'm saying is, I'm sorry, let me buy 100 shares here. You want to do a collar, you might not need to necessarily complicate things. Okay? Okay. Here's a collar, a little bit out of the money, risk of only 3.2% in the worst case scenario, and 1.8% maximum profit. Why am I bringing this up? Because remember, with the structure you were doing with the far out December call where your put was just expiring worthless, if the stock was at 155, you only made 174. I'm going to make more with this standard collar. Okay? And as the stock continues to go up, that call that you sold for 520 is increasing in value. You have to pay more to buy it back. Okay? So what's the deal? Well, here's a 3.2% risk if the stock's below 145, 483. That's equal to the dip that we saw. Okay, I mean, just like this. There you go. Hold on one second. And then it was like this. Okay. All right. So the risk at 145 was about the same for both. The max profit, if the stock's above 152.5 or is at 155, is $100 more than what I'd get with that other collar on October expiration. And if the stock fell to 140 or 135, I'm going to lose maybe only 100 or 150 here instead of the 483 with this structure. Why don't I like this structure? Because I can do just as well with the standard collar. And honestly, if I felt concerned that this stock could drop 11 points or 12 points, 8 or 9%, we know anything can happen, but if I felt it could drop 8 or 9%, I'm not going to do a covered call or a standard collar or a married put. I'm going to approach it a different way. Okay? This does give you good protection, and it gives you a worst case scenario if the stock's trading right here. I just don't think the benefits to the upside of these reverse collars outperform standard collar positions. Okay? And then you have to do the management. You either have to decide at the first expiration when your put either expires, or if the stock's below there, you close out the put, for example. On that reverse collar, you've got to decide now, do I buy back the call and just take the 1% gain? Do I buy another put and take what might have been a 7% gain down to a 3% gain? I have to add more money to stay in the position and keep protected. Sure, now it only has a 1% risk. Okay, that's true. But I would have been out with a 1.8% profit. Okay. So it's a trade-off there. The comparisons that we see here, you know, if the stock's at 155, I'm only making 1.8% or 267, which is $100 more than that standard collar on October expiration. If the stock's at 135, I'm going to be at a loss of 483. On the standard collar, we saw that your collar will only have been a loss at 310 actually at that point, okay? Because that long call still retains a lot of value. It's got a lot of time value even though it's out of the money. You should have to pay $2 to buy it back. And if the stock's trading right at 145, the risk is about the same for both positions. So, yeah, I'm not saying this is a bad limited risk trade. I see the benefit of having the low risk to where the maximum risk is only right at that peak. I do see the benefit there, and if it falls further, you lose less. But now I've got this sort of wide upper and lower break even. And the target, if we were thinking the stock's going to be at 155, 152, 153 in 30 days, the return on the standard collar is higher than that on the reverse collar. You know? And that's the reason. So what is the likelihood the stock's going to be trading right at 145 where your reverse collar will make the loss? I don't know. It's probably very slim, probably 5%. But at the same time, I changed that as well. And Bing says, okay, well, here's the trade-off, right? Bing says it's only applied to risky stocks that could go to zero. No, the gentleman that trades this, he's got a full structure on it. It's not as in depth as the radioactive trading blueprint, I don't think, with the rules and the 12 different adjustments. He has the structure for how he opens the positions. He might even open one of these on Apple, for example, like we saw on that. That's not it. I'm sorry. On the other spread, you know, he might even open it on Apple. And the benefit that he touts, of course, is that number one. I'm sorry, not this one, but on the other spread. Let's go back to it. I should just go back to the other spread too. So let me go over here now. But the benefit is you get more premium up front to pay for the put. What he doesn't, I don't think, do well, because it doesn't help sell his product, which is fine. Okay, the one flaw, oh, sorry, not AMD, Apple. The one flaw that it has is that investors come to me and they've asked me about this, and they say, well, you collect 520 for that December call, and so if the stock falls, the call goes to zero, you keep more of that 520. Well, no, it doesn't go to zero. It's still going to retain time value. Number two, you're always losing more on the stock than you're going to gain on the premium falling on the call. Okay, if that call goes to zero, it's because the stock dropped exponentially. You know, it's down trading at $100 per share instead of $150. So the sorry, folks. There we go. Let's go to December, and I was at the 155 call at 520, and we were at the October standard 145, 110. Okay. So you're seeing a positive premium. Yeah, you've lowered your cost basis down from, you know, 150. No, sell that call. That's what we want. Perfect. All right, there we go again. That's what we're looking for. So in the first month, sure, there's probably a very small chance the stock's going to be trading right at 145 and you'd lose that 448. My standard caller loses the 448 if the stock's trading below it at any time. But really, a target for this stock without a major event, could it be at 140? Yeah, but you're still losing 357. Could it be at 135? Yeah, but you're still losing 322. All right, so the risk is dropping down from 3% down to 2%, down to 1.5%. That's great. Okay, does it ever go profitable to the downside? No. Okay, if the stock drops to zero, you're not getting a profit on this position. That other one we saw you could, but that's because the volatilities were so out of whack. So let's go down to $1 per share. At least I don't think this one goes to profit. Now, it's still lost at $2.79. Okay, so when it really gaps down, you're still losing $2.79, which is about, you know, $110 less than the $487 risk I'd have on the standard collar. Now remember, the trick now is the management. Okay, so if the stock does go up and in the first month that my 145 put expires, I have to decide now, do I buy a 150 put for November? Or weeklies, I know, but let's just try to keep this as simple as possible. Do I buy the 150 November? Do I buy to close the December call? Oh, I'm sorry, we were at 155. My apologies. Do I buy to close the September call, which would now be a price at 547? Okay, because it's now slightly in the money and it retained a lot of its time value. It's going to move up. It's not going to decay in our favor. And then I make $300. So I'm still at a profit of 174. And again, the standard collar was at a profit of 267. Okay, 1.8%. So that's what's needed for the rest of this. What are the adjustments going forward? Could you buy a November 155 put and have no risk whatsoever? Yeah, we saw that. You could have bulletproofed it maybe with a November 150 even, depending on the price you get. But now your max, not where you are at 1% profit, but the max expected profit going forward is going to drop down to 2.6%, 2.4%. And now keep in mind this at November expiration when you've been in the trade for about, what is it, 58 days, 55 days? 56 days, yeah, there you go. So it's 56 days, you might only be looking at a profit of 1%. Sure, you've got a low risk, but does that match your trading plan? That's what you have to decide for yourself. When I see this structure, I see the benefits of it. There's only one way I could potentially lose that max amount of 448, and it's very slim that it's going to happen. The stock would have to be right at 145, and I'm sure that if the stock was falling, there's an adjustment to be made, whether it's with the call, whether it's with the put, what have you. I'm sure there's got to be something. If it falls further, we lose less. And you know, if the stock's in this area, we start to make the profit, but it's really not that high yet. You know, it starts to get at 160 or 170, you start to get more of that profit. But then you're giving back the 110, and to liquidate the position, to get that profit, you're going to pay a lot for this call, and then you got to sell to close the stock. So it's a trade-off. Okay, it is a low-risk trade. It has the benefits of low risk. It has the benefit of the maximum risk only occurring if the stock's trading at that point. One of the other things I mentioned, Martin, I'm sorry, and Bing, and I'll send you guys the links to those, the 3 core and other comparisons. And I mentioned this in that video. The one thing I really don't like about this as a structure up front, aside from the fact that it's different than what I do, that's not the key. I'm always looking at new things. I see the benefit of this. If you can get I've seen ones before where you get a profit and loss chart that looks like this. Let me scroll down a little bit and redraw that. Let me redraw that for you. Sorry about that. Let me scroll down here. Where you do have, and that's what Roger's looking for. He's seen this before too. You have a profit here. The max risk only occurs there, and then you've got a profit up here in the first month. So the only chance to lose is within this belt, and the only chance to take the maximum risk is right here. I'd say on paper, looking at that kind of profit and loss chart, which doesn't always come up with these strategies, but that kind of profit and loss chart might perform better long term over my standard collars. The only problem is that you need to be up here in this profit zone on those trades at least 40% of the time. And about 20% of the time in here, you can't afford to have 50% of your trades being here. Okay, you really need to be right over 65% of the time. And with that, I think 40% need to be in this higher win range on that position, because if you have 40% here and only 20 here, it's not going to counter what you're losing on the positions in here. Now, sure, there's management, but you need to be right much more often than wrong. With a standard collar, I only need to be right about 61% of the time to profit long term based on my structures, and thankfully I've been right about 68% of the time on my positions. And it's been lucrative for me. That's why I've been trading those since about 2002. Without 15% of my capital, I still use those standard collar positions for reasonable profit. I'd have to see more on this. And every webinar I've done, every discussion that we've had, I haven't seen the benefit. And where I was going, I'm sorry, where I trailed off there, my apologies, that I talk about in the other webinar is the construct. The construction of this trade goes against the simple, basic principles of options. The 3 core principles. What are they? When you buy an option, you typically want to buy further out in time. Why? Because the option that's 6 months out in time is not 6 times the cost. Okay? Well, sorry, what do I mean by that? That right now, this October 145 put is at 110. If I went to the February 145 put, it's not going to be worth 550. It's only going to be worth about 320. You pay less per day and less per month buying farther out insurance. Yes, you pay more up front, but the cost per day is less. You get a lower annualized cost buying further out in time, which means you get a lower annualized premium when you sell further out in time. To get the maximum annualized return for selling premium, you want to go week by week or month by month, because the option that's 6 months out in time is not going to be 6 times the cost. So here I'm lowering my annualized premium, increasing my annualized cost. It goes against one of the basic principles of options. It's a different way of looking at things. It is limited risk. There's only one chance I could lose that maximum risk. That is a huge benefit of this structure. But again, risk-reward ratio. You've got a small chance of getting the maximum risk. You've got low risk here and low risk in here. You just have to make sure really that you're up here 40–45% of the time, and in here 20% of the time. And just make sure that you're not, kind of in this area the remaining 35 or 40% of the time. If it's reversed, if you're only making 0.5 or 1% 45% of the time, and 3% 20% of the time, and over here you're wrong 3.5% 35% of the time, you won't have a winning track record. Okay, you just won't. The math doesn't work that way. So it's a trade-off. All right. Yeah, so you're saying up front, let me just do this real quick here. We are at 6 o'clock. Fantastic. But bang, I'm do this one more time. I'm going to take out the 20th October 145, and I'm going to go to the November 145 for you. The November against the December. This is going to be about 310 bid ask here. All right, so your risk is going to be lower, 3.6. Gain's going to be lower, 3.4 for a 56-day trade. Now, benefits of this structure, what are they? This structure here. Again, there's only one possible chance to lose that 3.6%, and it's right here. The risk-reward ratio looks fantastic. What do I mean by that? You're just essentially at a 1-to-1 risk-reward ratio. But remember, look at the structure of this trade at November expiration. Although, let's call it only a 5% chance, 5% probability, Apple would be trading right at 145 at November expiration and you would hit the maximum loss. Guess what? There's probably only a 1% probability the stock's going to be trading at 175 where you'd make the maximum 3.4%. This would be 0.2, 0.5, 1%. Now, right about here is 1%. I'm sorry, 1.5%, 1.75, 2%? Yeah, 2% right here. Okay, 2.5, maybe 3% here, whereas 470, okay? Yeah, so it's about 2.8% here. It's at 165. Okay, so although people say, oh, the risk-reward ratio is fantastic, it's closer to 1-to-1, and there's only a 5% chance you could take the maximum loss. There's only a 5% chance you're going to make that maximum gain. Okay, everywhere else here is lower numbers too, 0.2, 0.5. It's hard to see when drawing on it, but you get the idea. This is not the maximum profit. It's all the way up here somewhere in that first month. And sure, this is lower risk here, 1%, 2%. Still at about 3%, but then it probably goes back up to 2% if it really fell to like $110 or $100. You know, kept dropping down, maybe a little bit less, 280 I think it was. So there's only one chance here, but there's only one chance there. 5% probability of making the max profit or not. Whereas you remember that standard collar, there's probably a 35 or actually probably closer to 45% chance the stock would be above 152.50 and we'd make the 1.8% return anywhere above, and probably only a 25% chance that it would have been below the 145 we selected, where we only would have lost, what was it, 448? Yeah, 3%. Okay, so that's the difference. I mean, what did you do? By paying more for the put, you still take on a relative risk, and you could go to a higher strike at 150, but remember, what are you going to do? You're going to knock out that max profit, which only occurs way up here. Okay, just because it's above your short call, because it still has time to go, that does not mean you're at the profit of 3.4%. You're only there if the stock's really, really high and that call is deep in the money. Okay, that's the trade-off. All right, well, I think that about covers it for today. For our Friday session, I don't see any other questions coming in. There we go. Handled Michael's question. We took some great questions there from Rajiv. Bing, you've got some good points that came up as well. And we tried to analyze that different way of looking at it. Is it better to try to look for higher implied volatility or lower? It really just depends on what's being offered for the prices. I'm not saying you shouldn't investigate reverse collars more. I'm saying that right now, I just don't think that's a structure I like to, that's not a structure I like to use. So that's where I was taking a look at there. Okay. So remember, for those of you that are online with us still, if you haven't done so yet, make sure that you go ahead and take a look at, take a trial of PowerOptions. All you need is first name, last name, and email address. You can use the tools we showed today, plus a lot of the powerful tools for the searching, finding new positions, and more we didn't see today as well. Just remember the subscriptions after your 14-day free trial start at $40 a month for end-of-day data. We do offer real-time and a full set of historical tools where our historical data goes back to April of 2006. So you could do historical searches, see how those trades performed, help you develop your search a little bit more as well. For other free stuff, hey, don't forget to check out the blog. Those of you that have been waiting, of course, for the discussion on stock versus portfolio insurance, We talked about stock insurance a lot today, but how about insuring a portfolio? We covered the first basic parts of insuring just a stock-only portfolio with the blog today, blog.powerop.com. That's part 1 of the stock or portfolio insurance. I hope to have part 2 posted this weekend, as well as this webinar, and later on, maybe this evening or tomorrow, Martin and Bing, I will send you guys the links we talked about for those other webinars and what's available. Of course, you can go to the webinars page, powerop.com/webinars.asp. My first 2 discussions on the reverse collar are in the requested topics section of the free webinars page from March 14th, 2017. I think it was April 7th as well. You'll see the title there, Reverse Collars and More. Remember, you can always check us out on YouTube also. All right, so any other questions come up? Bing says, thank you very much. Have a fantastic weekend. Thank you, Bing. Take care of yourself. Rajiv says diagonal could help for AXON. And yeah, we could look at a diagonal. That's just another way of evaluating those positions also. Okay. He was looking at a diagonal, I'm sorry, on the AXON position. 50 strike at 440 and buy the November for 530. Interesting. Interesting structure. I might take a look at that on the diagonal, see what we can come up with. All right. So yeah, again, if you do think any questions at any time, just remember to send me an email to support@powerop.com. And of course, you can also send us an email at any time to support@radioactivetrading.com if you have questions about the married put positions and more as well. Okay. And remember, you can also reach me during market hours by phone. You can call 302-992-7971. Both Ernie and myself will be available during the day also. Okay. All right. So thanks a lot, ladies and gentlemen. I'll get this webinar converted. I'll get it posted for you this weekend. I'll let everyone know when it's posted, and I'll let you know when that second series comes up for the stock or portfolio insurance as well. Located at the blog, blog.powerop.com. There will also be stuff on YouTube also that'll be public for that series. Ladies and gentlemen, have a fantastic weekend. Have a fantastic evening also. We'll see you next week, see what the market has in store for us. Take care. Good night.